makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Fitch strips the U.S. of its AAA credit rating, citing ballooning deficits and an erosion of governance. Treasury yields moved higher before stabilizing. Treasury Secretary Janet Yellen blasted a surprise decision, calling it arbitrary and outdated. Plus, Trump charged the former president is indicted over his efforts to overturn the 2020 presidential election, charges he has repeatedly denied. So good morning, everyone. Let's take a look at the European markets map. Everything has to do with what happened in the U.S. Investors say that Fitch's U.S. downgrade may do little to deter the top-notch status of U.S. assets over the longer term. But for the moment, we're seeing a little bit of pressure. Across the board, we're seeing down futures in the U.S. Of course, what traders are pointing to is solid growth in the U.S., but also no real alternative. Now, they're also taking cues from what transpired in the wake of a similar event in 2011 when S&P removed the highest rating for the U.S. following an earlier debt ceiling crisis. The main question is, what does positioning look like today, and where are we going to see the main pitfalls? Now, while that triggered a sell-off in risk assets around the world, it did boost treasuries in the short term as investors sought out havens. So that's something that we need to spend a bit of time on. On the surface, the U.S. is facing a huge amount of debt and interest payments, $32.6 trillion in total debt, $970 billion total interest. Both measures are at a record high. And then if you look at the average interest rate paid on U.S. debt, still well below 3%, below inflation. That means that real borrowing costs are still negative. I mean, we're lucky. We have all of the Bloomberg charts to support some of the analysis that will bring you throughout the hour. Traders also bracing for this $102 billion wave of Treasury bond issuance for the quarterly refunding announcement. What you're seeing on screen are basically dealer projections. So we'll have full team coverage, all of the reaction to the downgrade, charts analysis, and expert opinions. So joining us now is Bloomberg's Valerie Teitel, looking at some of the great charts that she's been delving into. Val, what's the consequence of all of this?
Well, Francine, I want to talk about the U.S.'s debt to GDP ratio and tag it to the reasons in which Fitch made this decision overnight. Fitch had three reasons that triggered this downgrade, one of them being the expected fiscal deterioration. And I want to point out that normally when we head into a recession, the government accounts do deteriorate. You can see that in 2008 and then when we headed into the pandemic recession as well. Fitch does forecast a recession for the U.S. starting later this year, early next year. So they're already penciling in a worsening debt to GDP ratio as we go forward. They also blamed a high and growing debt burden. Now, if we look at the median of Fitch's AAA, the U.S.'s debt to GDP is 2.5 times higher than the rest. They specifically pointed that out in their note. And then lastly, their last reason for this downgrade was an erosion of governments and erosion in confidence in fiscal management. That is saying that if the debt to GDP ratios get to a worse level, there's just less confidence that the U.S. government can do something about it. Now, it's hard to say why they chose specifically now to make this decision, Francine, but we did have the announcement from the Treasury on Monday about third quarter borrowing. It came in way above estimates. They plan on borrowing $1 trillion in the third quarter, which is a record and above estimates. We also know that their interest payments have been ballooning. Those higher interest rates are causing interest payments to nearly run at a $1 trillion annualized pace. So these are two things that have escalated in the recent months. And it poses an answer maybe on why Fitch chose now to do this downgrade.
Yeah, Valerie, the $1 million question, thank you, or the $1 trillion question, I should say. Valerie Teitel there with all of the charts that matter. Now, joining us is Bloomberg's Markets Today Managing Editor Christina Aquino and M&G's Chief Investment Officer for Equities and Multi Asset, Fabiana Fedeli. So thank you both for joining us. Fabiana, longer term, how much of an impact will this have on the perception of the U.S., or is actually Janet Yellen right? This is backward looking.
It is backward looking. I mean, if the timing is surprising, it is very clear what the reason for it is. This constant debacle on the debt ceiling, the deterioration of the balance sheet of the United States. Now, until the US dollar remains the base currency of the world, I really can't see an alternative to treasuries in many circumstances, besides the fact that for some collateral trades, for example, on AAAs, the US dollar will have to, or the treasuries will have to be removed. But other than that, I don't think longer term this brings much difference to the table.
Yeah, Christine, I guess the worry is that there's 102 billion in issuance, and I don't know whether at the margins, again, we're just going to see quite a lot of volatility over the next 2 to 3 weeks, especially when that huge amount of money is coming out.
Absolutely, Francine. And adding to all of that volatility, of course, we're very much deeply into summer markets at the moment, which perhaps explains a little bit of Fitch's thinking in terms of going with the announcement now, right? If you want to make maximum impact in markets, you kind of do it when there's not a lot else going on. And that seems to be the logic at play here. But yeah, I mean, I think at the very least, what we're seeing today is kind of that immediate sentiment hit from the Fitch move, right? Well, we're seeing everything being sold off in terms of risk assets, and then havens are in play. I would note, though, that it really isn't that outsized of a reaction, particularly in bond markets. Certainly not as much as we saw in 2011 when I was a cub reporter experiencing this for the first time and covering bond markets back then. I mean, I remember the reaction back then was quite significant just because it was the first downgrade by S&P. It was they were the first mover. It seems like, a few years later or a decade later, the reaction isn't as big as maybe Fitch hopes.
I mean, is this a worry, Fabiana? If we're starting to talk about, some of these credit rating agency doing it in the week to have market impact. I mean, this is not a central bank. This is not what they're supposed to do. I mean, this usually happens on a Friday once the market are closed, and actually, so they don't make a splash and a wave on the markets.
Well, we don't really know what the reasons for the timing are, right? In the end, the reasons for this are pretty clear, are understandable. I believe a lot of investors out there have already taken those reasons into account in their investments. So again, while I very much agree that there is a first reaction, I really don't see this as lasting.
Christine, and we have a big number. This is something that we're going to now do daily. We have a big number, and today our big number is $1 trillion. So the Treasury increased its net borrowing estimate for the July through September quarter to $1 trillion, more than some analysts had expected, and certainly well above the $733 billion that I had predicted in early May. So the Treasury will preview its quarterly financing plans also today, which is what we're talking about in terms of issuance. I mean, does that change their thinking in terms of how much they can borrow, or does it not really impact politics in Washington?
Yeah, it's quite interesting, Francine. I think, those plans are already in play well before what we saw from the Fitch decision overnight. So I don't really think it's going to make the U.S. suddenly reverse course in terms of borrowing plans. But yeah, I think moving forward, there are political implications here. I could easily see this Fitch move being brought up in the politics. We're heading into the election cycle. This is definitely something that the GOP can use against the Biden administration as evidence of mismanagement of the country's fiscal position. Whether or not that's true, of course, very much up for debate and not really something for us to comment on. But, at the very least, yeah, this move is certainly something that could make the politics for the Biden administration quite difficult at this point in time.
And Fabiana, if you look at the main market drivers, and we go back to central banks and inflation, of course, all the data points that we received.
Look, I think this is independent right now from the downgrade. We see the Fed be in a completely different position, for example, from the ECB and from the BOE, and for emerging markets banks. You already saw Chile last week cutting by 100 basis points. Brazil will probably cut by 50 basis points today. And the Fed is possibly close to the end of the cycle with maybe one more increase. ECB and BOE, they still have some ground to cover.
Thank you so much. We'll also talk a little bit about currencies shortly. M&G's Fabiana Fedeli and Christine Aquino going through, of course, a big story about the downgrade from the U.S. Also coming up, Donald Trump charged. The former president is indicted over his efforts to overturn the 2020 presidential election. Charges he has repeatedly denied. So we'll bring you all of the details next, and this is Bloomberg. Welcome back. Donald Trump has been indicted on federal charges, accused of a conspiracy to overturn the 2020 presidential election. Now, this is the former U.S. president's third criminal indictment as he makes his latest run for the White House. Now, he has repeatedly denied any wrongdoing. Well, joining us now is Bloomberg's Rosalind Matheson. So, Ros, good morning. What does that actually mean for Trump's campaign?
Well, it's interesting, this being the third indictment in 4 months that he's faced, but he's been using this to really try and mobilise his campaign, mobilise his base. He's saying particularly these charges coming now, several years after the event, are very political. He says the Department of Justice really is an extension of the Biden administration, so using this to kind of whip up his base. And he does really need to do that because he needs to raise a lot of money for all these legal cases. And those people who are giving money to his campaign are essentially now funding these extensive legal cases. But what we've seen is he's actually used these as leverage to get support. You'd think all these legal cases would start to work against him, but oddly enough, it's something that he uses to get energy from, in a way, and energise his base. And we've seen that reflected in his opinion polling. So certainly this latest legal case may not necessarily harm him in those opinion polls.
So, Ros, what happens now?
Well, he's due to appear tomorrow in court, but a lot of these cases could go for months, if not years. They could run into the election campaign next year if he does indeed get the Republican nomination. Then perhaps there's a precedent where he's a sitting US president still facing all these legal cases. He's tried to push them back beyond the campaign. He says that they're interfering with his efforts to seek the Republican nomination, but it's very likely we're going to see a series of court cases, court appearances, some of these things actually getting underway late in the piece next year, possibly right when the election campaign is reaching its peak. But certainly we expect him to appear in court tomorrow in Washington, and that's where we'll expect him to say the same things again. These are fake charges against him. He'll use it again as a moment to try and whip up his base.
Ros, thanks so much. Bloomberg's Rosalind Matheson there. Now we're back with Bloomberg's Markets Today. Managing Editor Christina Kino and M&G's Chief Investment Officer for Equities and Multi Asset, Fabiana Fedeli. So thank you both for staying with us. Fabiana, when you look at some of the positioning that we're seeing on the markets now, what feels wrong at the moment that you would change into September?
Look, what we're seeing right now is a most likely soft landing for now in the United States. You see macroeconomic numbers being constructive and supportive, less so in Europe, but you see some differences between countries such as France, for example, and Spain doing much better than Germany. So there's quite a dispersion in terms of where the world is going from a macroeconomic standpoint. What it feels like now is that we're not anywhere near a deep recession or a credit event, which means that it's probably too early to throw the towel in on risk assets. So you can still stay in equities, you can still stay in credit, but just stay very high on the quality side. And that is the area where the market doesn't necessarily position itself in that way. So we have seen a resurgence of high yield trading and also some bottom fishing in equities. I would be very cautious on that.
What have the earnings told you so far?
Very interesting. They continue to tell us that different companies with small different tilts in exposure, with better balance sheets, ultimately better pricing power and better management, are doing much better than others, even in the same sectors. So it's really a market that continues to call for selection.
And it feels, Christine, like a lot of market participants actually look to the forecasts for the companies longer term rather than, for example, margin and things like that.
Absolutely, Francine. And, that future outlook for profits and earnings per share definitely still very much on the radar for investors. And I think you could understand also why some of the companies, particularly in the UK, have really been trying to mitigate against that. I mean, one big theme that we've seen over here is this theme of big buybacks, right? We've seen it definitely from the major UK banks that have reported thus far, as well as big oil. And you can understand, I think for the banks, it's definitely them trying to give investors the benefits of those net interest margin profits that they've seen over the last year or so, just before that may be starting to fade, right? And there's definitely that theme of, it's the best of that margin story behind us. And then when it comes to big oil, I think what we're seeing is buybacks acting as a bit of a sugar pill for investors, because we have seen profits kind of moderate from the very, very high levels that we saw last year as energy costs kind of come down a little bit. But, there's definitely this effort for companies to keep investors happy, even if the outlook's maybe a little shaky in the future.
And Fabiana, when you look at, I mean, there's David Finnerty, one of also our markets live bloggers, saying, look, it's really the U.S. payrolls number on Friday that will move treasuries more than maybe than what we heard from Fitch. What's your expectation for the U.S. economy? Are we going to avoid a recession?
So it does look, first and foremost, I would agree that it's not necessarily only the payroll number, but all the macroeconomic data and the inflation numbers that will really keep these markets going or not. And in terms of what we expect from a recession standpoint, you know, we are at a point where possibly there's going to be a soft landing in the near term, but companies and consumers will have to deal with higher for longer interest rates. So that means that spending will most likely come down, and that could bring a recession, possibly not in the near future, but definitely deterioration of numbers going forward. And we need to take that into account when we invest.
So where do you see the best opportunities? I know you mentioned Japan, but also, for example, some of the emerging markets that you say are a fertile area for opportunities.
So one of the things that we're telling clients is don't make big macro trades. Don't only look at one country. Really try to stay selective within countries and within themes. No. And we see some interesting companies in Japan. We see interesting companies in India. We also see interesting companies in Europe. But again, it's a very differentiated market.
Christine, oil market, or actually the oil price is going up. Does that change markets' focus at all?
Well, I think it's another factor for markets to keep track of, Francine, for sure, because again, you know, we're still kind of dealing with the repercussions of elevated inflation and obviously oil prices feeding into that. Again, you know, just this earnings season, the big question for a lot of companies is, are they still going to be able to wield that pricing power, right? It was all about margins. And what we're seeing on the energy cost front, very much a part of that. We have seen some silver linings for some companies saying that, oh, input costs are a bit lower now, largely because of the lower materials and energy prices. But if that's something that's kind of come back as a risk for companies, then that could potentially change the equation for the second half.
Thank you both for joining us. Christina Aquino from Bloomberg and M&G, Chief Investment Officer, Equities and Multi Assets. Of course, Fabiana Fedeli joining us for some great calls going forward. Now, coming up, AMD gains after the chip maker tops estimates and touts inroads in AI computing. We'll have a full roundup of what they said. That's next, and this is Bloomberg.
We're very excited about this. It's a seminal moment for Uber to deliver GAAP operating profit, free cash flow of over $1 billion just in the quarter, along with a really strong top line. You look at a gross bookings growth that was $33.6 billion.
Well, that was Uber Chief Executive Dara Khosrowshahi. They're hailing the company's first ever operating profit milestone was eclipsed by a pace of growth that has slowed from pandemic highs, sending the shares down the most in 9 years. Now, AMD gained in pre-market trading after the chip maker topped second quarter estimates and touted inroads in artificial intelligence computing. The announcement putting it closer competition with NVIDIA. Well, joining us now is our tech reporter, Aggie Cantrell. Aggie, good morning. So AMD has seen quite a turnaround this quarter off the back of AI interest. Is it a second NVIDIA?
Yes, Francine. So as people have been saying, in the current market, there are chips and then there are chips. And what the distinction is there is what these companies are doing when it comes to artificial intelligence. And AMD has gained a lot of interest from customers because of their efforts towards things like the AMD accelerators that are essentially able to be used to speed up the development of artificial intelligence. And retooling data centers is a big part of that. A lot of big tech companies are looking to retool their data centers so that they can commit all of this effort towards artificial intelligence, and chips are needed for that. And the likes of AMD, just like NVIDIA, are quite well positioned to do that. The CEO of AMD said yesterday that she thinks that the market for AI chips in data centers is going to be at $150 billion by 2027. So they see this as a real opportunity for them. And then also they are a big producer of PC chips as well. And just as we saw with Intel last week, they're also seeing a renewed demand in that market as well after quite a few lackluster quarters.
Aggie, thank you so much. So what are you looking out for very quickly in Qualcomm earnings?
Yes, so essentially PC demand is that thing that we're also looking when it comes to Qualcomm, when it comes to consumer tech demand, and when it comes to smartphones. Qualcomm is a big provider of smartphone chips, and we're seeing that now a lot of customers are returning to the market and looking to buy more chips for their smartphones, having had huge inventories for a long time. So the thing that investors will be looking out for when it comes to Qualcomm is making sure that they have been able to bear into the stockpiles that their customers have taken, and that as people are buying smartphones again.
Aggie, thank you so much. Aggie Cantrell there. Now, coming up, oil rallies after a report pointing to huge drawdowns in U.S. inventory. So we'll discuss that next. We'll have a full roundup of not only what's going on with crude, but also treasuries on the back of Fitch downgrading the U.S. This is Bloomberg. Fitch strips the U.S. of its AAA credit rating, citing ballooning deficits and an erosion of governance. Treasury yields move higher before stabilizing. Treasury Secretary Janet Yellen blasts the surprise decision, calling it arbitrary and outdated. Plus, Trump charged the former president is indicted over his efforts to overturn the 2020 presidential election, charges he has repeatedly denied. Good morning, everyone. Happy Wednesday. Welcome to The Pulse. I'm Francine Lacqua here in London. So oil has resumed a rally after an industry estimate pointed to a huge drawdown in U.S. inventories, adding to signals that the market is tightening. Well, joining us now is Bloomberg's Anthony Di Paola. Anthony, good morning. So what exactly is driving oil's gains?
Good morning. Oil is continuing to rise after having a bumper month of July. And really, this is a supply-driven market. So what's pushing up oil is the issues on supply. That's OPEC Plus cutting back production. We've got some supply disruptions in certain areas. And so that's what's really moving the market. We are seeing forecasts on the demand side that we're going to hit peak demand, so highest ever demand this year. And that is giving some underpinning to the market. But that much waited for surge in supply from China has still not come, as that recovery is still a little bit sluggish. So it's really the supply side that we're looking at, mainly those OPEC cuts and those outages. We're talking about 500,000 barrels of oil that's still offline in Iraq due to pipeline disruption. Libya, Nigeria, and Venezuela continually vacillating in terms of their production, going up and down, and still losing some barrels there. Yeah. Plus Russia coming in with their timely cut. So that's really affecting the market, Francine.
So where do OPEC Plus and China fit into this picture going forward?
Well, OPEC Plus has said that they're going to keep their current level of quotas in place through the end of the year. So that's underpinning the market. Plus, we've got voluntary cuts on top of that. And that's coming from Saudi Arabia. They've decided to take another 1 million barrels off the market. And we're going to be seeing in the next couple days whether they continue that. They've got the market a little bit on tenterhooks there because they've said that they're going to decide on that on a monthly basis. So we're going to have to wait as we go ahead and see month by month whether Saudi Arabia continues to continue that cut. On the Saudi side, for sure, they're looking at China. We're seeing some potential signs that Bloomberg News reported overnight that demand has probably peaked this year in China. So that's going to be bad news. Obviously, that will hold up, but we won't see potentially more of a bump from China later this year. So that's those are those two factors, again, on the supply and the demand side that are affecting the market, Francine.
Anthony, thank you so much for joining us today. Anthony DiPaolo there from Bloomberg in Dubai. Now, staying with energy, and today's big take actually looks at how one of the UK's biggest energy producers managed to avoid repaying £639 million to taxpayers during a historic inflation crisis. Now, the company did not break any rules, but 3 former UK energy secretaries who oversaw subsidy policy have told Bloomberg that Drax appears to have violated the spirit of its 2014 agreement. Well, joining us now to discuss all of this is Bloomberg's European power reporter, Todd Gillespie. Todd, first of all, congratulations on a really great and important big take today that we're pushing out on all of our social media channels. So first of all, explain how this subsidy deal between Drax and the UK government was supposed to work.
Thanks, Francine. So basically, since 2016, Drax, which uses biomass to produce electricity at its Northern England power plant, which is a very expensive form of fuel, it's been getting subsidies basically from taxes on consumers' bills to make sure that it can produce that power profitably relative to other companies that can make it for a lower cost. And the idea was that once the market price went above, if it ever spiked above this kind of agreed fixed price, that money, any excess profit, would basically start flowing back to consumers.
So how did they avoid that? How did they avoid paying UK consumers?
Well, essentially, they basically switched off one unit at their power plant that was on this subsidy scheme. They moved the fuel to the other units, or they sold it on the open market, where prices had spiked because of Russia's war in Ukraine, which disrupted global biomass supplies. So the company was able to nearly double its EBITDA last year on the back of this very canny trading maneuver. But secretaries of state, 3 former secretaries of state who oversaw energy policy that we've spoken to, accused the company of violating the spirit of its agreement. And it comes at a time when the company is really in-depth in talks with the government about getting more public money for carbon capture and things like that. So it's quite a politically risky move for them to do.
So what's been the response from Drax?
Well, Drax say that they used this biomass supply in other units. It had already locked in hedged supply for the other units. So it didn't necessarily have as much supply available for the units that it said, the unit that was on this subsidy scheme. But at the same time, its CEO and its CFO have publicly said in earnings calls with analysts that the company has sought to optimize its strategy, regardless of the impact that it's had on consumers during this crisis.
So, Todd, Ed Davey, who negotiated the company's subsidy deal as Secretary of State for Energy and Climate Change, did not mince his words. I mean, this is gaming the contract, he said.
I mean, that's the argument. I mean, these contracts were really designed, after years of having just one-way subsidies. Consumers would just top up companies, and there'd be no necessary payback for consumers afterwards. And the whole idea was that this was a 2-way deal, and Drax essentially was able to opt out of that 2-way deal once it did this, and at a time that was really critical for consumers.
Todd, thank you so much. Great reporting, and of course a great story that everyone should read on the Bloomberg terminal or on our website. Bloomberg's European power reporter, Todd Gillespie there. Now, don't miss our coverage also of the Bank of England's latest policy decision tomorrow. The decision due at midday UK time with a press conference 30 minutes later. It's interesting because, of course, this is the decision on knife edge, 25 or 50 basis points. We'll, of course, also be covering all things UK every week on Thursdays, 9:30 a.m. London time in our half-an-hour special. Tomorrow, we're looking at the future of the UK housing market. And this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in London. So Fitch has stripped the U.S. of its top-tier AAA sovereign credit grade. Reasons behind the downgrade include ballooning deficits and an erosion of governance. Well, joining us now to discuss is Jens Nordvig. He's founder and chief executive of Exante Data. He's also one of the most well-respected Wall Street voices. So I'm really happy that you're in London by chance this week, Jens. Thank you so much for joining us. I don't know whether this has longer-term effects or whether you take 2011 as a template and say, look, there's no real alternative. The U.S. is not going to default. It doesn't really change that much.
Yeah. I think when we analyze this type of downgrade, at least from a short-term perspective, we think about, is there anybody who has to sell anything as a function of this change? And I think in 2011, that would have been the case. There were entities that could only hold AAA assets, or they had to give AAA assets as collateral. But that has really changed in that period since. We tried to do the numbers again last night. Like, it's very hard to find funds, entities that are excluded from other stuff than AAA. So I don't think there's going to be a lot of forced selling, right? So the question is there some kind of sentiment shift that's going to happen as a function of that? Clearly, it's not good news. But if we look at the initial market reaction, pretty moderate reaction in the bond market, pretty moderate reaction in the currency market and in the equity market. But the equity market was perhaps already starting to be a little bit shaky before this news come out, and maybe that's continuing to.
But yeah, so there's 102 billion coming up for issuance in the next 10 days.
Yeah.
Does that change appetite?
So I think the problem with the U.S. bond market is that even before this news, we had a kind of flow situation that was starting to look pretty shaky. Japan have their own kind of bond issues. They've stopped buying U.S. bonds over the last 3 weeks. Bond funds in the U.S., we track them one by one. They've already been buying a lot of bonds over the 9 months, and they kind of probably have more limited capacity to really add to that. So what we've seen over the last couple of weeks is that in the absence of any bad news, yields are drifting higher. And we've even seen that in the last couple of days. Now we have the funding announcement coming later today, right, where a lot of bonds are going to be issued. So it was already shaking, and clearly the news we've had today is not going to make appetite for buying U.S. bonds particularly strong.
But so, yeah, where's the biggest mispricing when it comes to global rates market?
Well, so I think after we had the U.S. CPI print that got everybody excited that maybe the Fed can start to relax a little bit, we started to price very aggressive rate cuts. If we look at 2024, we had 150 basis points priced. That's not really what the signals from the economy are showing, right? Okay, maybe headline inflation is coming down. Labor market still looks very robust. Every time I speak to CEOs or something like that are hiring in the U.S., they always tell me the labor market is tight, right? So it's hard to see the Fed being forced to cut rates aggressively unless, financial conditions take a big turn down.
So what cuts are for 2025?
Yeah, I think that's a long time frame. Over that time frame, right, what is happening over time is that more and more people who have to borrow are rolling into these higher rates, but it doesn't happen from one day to the other.
But so if you look, so let's talk about the Fed just stopping hiking, right? Not talking about cutting. What are the currencies that benefit and lose the most just from that immediate effect?
So what we've seen over the last couple of months is that it really depends a lot on what risk sentiment is, right? So you can do kind of emerging market currencies. Emerging market currencies actually had a really great run during this period where the U.S. equity market was doing very well. So we talk about the strong dollar, but actually LATAM currencies were even stronger. And then in those periods where the equity market turned, you have the yen and the Swiss franc. So it really depends a lot on what risk assets are doing. And that's what we've seen over the last couple of months.
So going back to BOJ, what's the biggest impact actually of that shift?
Well, I think we actually get data today on what is the weekly flow in and out of Japan, right? And as I mentioned earlier, we've already seen over the last 3 weeks that Japanese investors are not putting money into the U.S. bond market anymore. And Japanese fixed income investors are very important in global fixed income markets and the U.S. market, right? So if they stop that because they now have higher yields domestically, that, I think, is an issue if the U.S. bond market is already looking a bit shaky. So I think that's something to watch very closely.
Do you think that actually the end of yield curve control is a given? And by when?
So I think effectively the yield curve control is already dead. Okay. So now it's just a transition phase where they smooth the transition to a new regime. But I think it's already been abandoned. It's the right decision, right? And now it's just a matter of how quickly do they allow the yield curve to actually adjust to that new reality.
Are you, I mean, this is a question that we could talk about for like 5 hours, right? If you look at inflation, how are you, are you sure that central banks are not getting it wrong again? Inflation doesn't spike back up?
I have a lot of clients that crunch CPI numbers in intense detail, and I think amongst the ones that really go into the detail, there's sort of a consensus that the next couple of prints are going to look okay.
Yeah.
And then when we get to Q4, the numbers are going to be higher again. That's another argument that it's going to be hard for the Fed to actually cut. in 2024.
But what does that tell us? Like, it's unclear. I mean, these patterns, is it because of COVID? Is it a tight labor market? Is it structural forces that we don't understand?
I think when you look at what's going on with inflation globally, we don't have goods price inflation anymore. Over the last 4 or 5 months, we've essentially had goods prices flat, not just at 2% inflation target, but below. So that problem has kind of gone away. And the remaining problem is wages still going up more than is consistent with target, and the services prices following. But that also depends on which country you're looking at, right? So those economies where the services sector is big are going to facing that problem. The other economies where that's less of the basket and perhaps they're more linked to China actually have a different inflation dynamic now.
But so you're expecting, I mean, this is worrying, right? Because you could have a situation where inflation's picking up again, but actually interest rate hikes are starting to have an impact on the economy.
It's not easy to be a central banker, right? Because of the...
Or a market participant, frankly.
No, you could say that too. The central banks have like a real tension between inflation that is still way above target on services, right? And then growth starting to turn. In the last 15 years, we have been used to a regime where as soon as growth turns, we got easy policy, right? And I think this is the real tricky bit. It's the same for the ECB, right? A lot of people are looking at the PMIs turning over, but I don't think it's going to be so easy for the ECB to stop if core inflation is still printing way, way above target.
Jens, thank you. Jens Nordvig, he is the founder and chief executive of Exante Data, and he, of course, stays with us. Now, the conversations that matter, the insights you need, will continue with Jens, and we'll talk even about the UK and the Bank of England tomorrow. This is Bloomberg. Welcome back. Still with us, Jens Nordvig. He is founder and chief executive of Exante Data. Jens, we talked a little bit. First of all, thank you so much for sticking around. But we talked a bit about the BOJ policy shift, yield curve control. Talked about inflation and treasury. When you look at real yields, are they sufficiently restrictive in both the U.S. and Europe, or do they still have further to go?
So I think this year, like if I was going to say one key word for the whole year, it's credit, right? So I spent a lot of time on looking at credit dynamics globally. And we can see credit dynamics are slowing quite dramatically in Europe. ECB has commented on that as well. In the US, credit dynamics are slowing, but I think people are a little bit surprised that they're not slowing faster because they thought there was going to be a massive shock from Silicon Valley Bank. To finish off with Bank of Japan, they're actually seeing the opposite. Credit growth is quite strong in Japan, which fits with their real rates not being high, right? So monetary policy matters, and you can see it in the credit dynamics around the world.
What's your biggest worry about Europe? So I know you mentioned PMIs that could be a little bit wobbly going into next year, but we're also seeing, I guess, spending not having such a easy trajectory that maybe some economists had thought.
Yeah, I think the concern for the economic outlook is often linked to what's going on in the labor market, right? So the labor market has been holding up quite well. Like when we look at hiring, we still have respectable hiring in many Eurozone countries. Unfortunately, the data comes out very slowly in Europe, so we don't have as good data as we have in the US. But I think that's what would concern me. If that weakens further, I would say, okay, we're heading into a very tough time, but it's not at that point yet.
I know you like looking at quirky charts, which is why I love following you actually on Twitter as well. If you look at income and expenditure, side estimates of U.S. output growth, and there's a paper from Brookings Institute, I don't know whether there's, a divergence, for example, that we're seeing in GDP growth and GDI growth that we need to pay attention to. Is there something that you're paying attention to which is off the beaten track that gives us a glimpse of what we should be looking out for?
Well, so I think related to essentially who makes the money, are we having increasing inequality? All those things are tied, right? So we have a situation now where there's a lot of focus on AI in the market and other places, right? And I think the concern with those accounts is that we're going into a phase where increasingly the extra value added in the economy will be derived from some very big companies, and that's going to skew the income distribution even further. and not be good for demand going forward. So I think that's what to watch for in that data right now.
Are central banks aware of this? Or, I mean, is there a blind spot actually that you're seeing that could make them take a wrong decision?
I think central banks are reluctant to take strong views on these new trends until they can see clear evidence of in the data. I think there's going to be a debate about, oh, how's our star going to be impacted by this stuff, but it's too academic for them to set policy on it. To be honest, policy is going to be very much a function of what the core inflation is in the next couple of months, because they don't trust their forecast that much anymore, because they've been very wrong for 2 years now.
How difficult is it being a Bank of England official right now? So they have a decision tomorrow, 25 or 50 basis points. It's kind of on knife edge, but it's also a lot of complexity. I mean, they even drafted Ben Bernanke to have a look at forecasts.
So Bank of England is facing a very tough situation, right? We know the high interest rates are going to be causing serious issues for mortgage holders as those reset. But in addition to the underlying challenges, I think they've also created some challenges for themselves with, I would say, pretty erratic communication, kind of a bit stop-go with the pace of tightening. So that's going to be a tough communication. I think they're going to try to be quite hawkish, but not continue with the 50 basis points. So it's going to be a weird mix. They're going to have to, again, explain their forecast, which comes out of a model that not a lot of people have a lot of confidence in. So not an easy job they have on their hands.
I mean, talking about models, you're founding another company because you're not busy enough, looking at like algorithms and basically what are you trying to study that you think is lacking in the market?
We're trying to solve a very simple problem that essentially everybody in the market has. We want to understand why is the market moving. Markets are complex, right? So it's not such an easy thing to answer all the time. So we want to attack that with a lot of data across a lot of different dimensions and really give people an objective, real-time answer to why we have gaps in the markets for stocks, macro assets, and so forth.
And you think, is there more of a gap with what markets are doing than what the economy is doing? Because the economy, I mean, we've read the economy wrong on multiple occasions for multiple years.
Well, so in the new company that we're launching called Market Reader, our focus is to give objective explanations of what is happening. Okay. That could be tied to economics, it could be tied to something else. Anything that we think is relevant will be surfaced.
So send your questions to Jens on Twitter and he'll answer them for you. Jens, thank you so much, as always, for joining us. Jens Nordvig there, founder and chief executive of Exante Data. Now, tomorrow, don't forget, we also kickstart our coverage from the Aspen Economic Strategy Group. A host of policymakers and executives will weigh in on solutions to the biggest issues affecting commerce in the U.S. and elsewhere. Also tomorrow, it's Bank of England. We spoke about it with Jens. And then we have a special show dedicated to the Bank of England. And then after the press conference, I'll also be speaking to the governor, Andrew Bailey. Now, up next, the Bloomberg Surveillance Early Edition with Kriti Gupta in New York, Danny Berger in London. They'll continue market checks. Our main story, of course, what happened overnight, or actually late last night, I would say, the U.S. being stripped of its AAA rating by Fitch, of course, as budget deficits are swelling. This is Bloomberg.